Hello, this is Ilan Awerbuch with the Unitrust Companies in San Diego, and this is Mortgage Watch, providing you mortgage and financial news that you can use. There's a famous French adage that says the more things change, the more they remain the same. Nowhere is that more true than the U.S. economy and financial markets. After several years of upheaval and near collapse, we're again seeing record Wall Street profits and bonuses. Yet the average American is struggling to get back on their feet. Indicators are showing that the gap between have and have-nots in our country is increasing. A recent survey showed that 40% of Americans have either lost their homes in foreclosure, are 2 or more months down on their mortgage, or have lost their jobs. The Federal Reserve's actions in buying mortgage-backed securities were supposed to help keep interest rates low, but have instead boosted corporate outlook and earnings while spiking interest rates. While rates are still very good by historical standards, they have increased by over 1% from where they were just 3 months ago. The White House has called for tougher underwriting standards to accompany the dismantling of Fannie Mae and Freddie Mac, the government housing agencies. In addition, the White House argued that the 30-year fixed-rate mortgage is outdated and should be replaced by more market-driven programs, meaning shorter-term fixed like 7-1, 5-1, or 10-1 ARMs. The recent upheaval in oil-producing Middle Eastern countries would normally have resulted in mortgage rates coming down as investors near and far take the famous flight to safety buying up U.S. Treasuries. That hasn't really happened, causing us to ask if investors know something the rest of us don't, or are simply being incredibly naive again as they were 3 to 5 years ago. Most investors stuck with the stock market most of the way down and incurred 25 to 40% losses in their portfolios. The bottom line is that interest rates, though higher than they were recently, are still in very good territory. If you have a 5-1 or 7-1 ARM that's gone into its adjustable mode, the rates on those are currently great, mostly in the 3% range. If you're okay with your loan payment when rates go back up in coming years to their historical norm, you can stick with it. But the historical trends tell us that rates will go back up over the next few years, so you'll be in at least the 7 to 8% range for some time, possibly years, before rates start their downward cycle again. And if you think all this federal stimulus is going to cause higher inflation in years to come, then it's time to analyze what your future could look like and take action now to avoid a bad scenario. Take charge of your financial future and don't become a victim of future circumstances. If you'd like some further tips on how to do that, please respond to this blog and we'll send you some free information. Next week, I'll update you on the facts about the huge changes coming to the mortgage industry and all mortgages starting April 1. These changes will affect all new mortgages, whether originated by bank, broker, or banker, and you'll want to be prepared for that. In the meantime, I wish you a very good week. This is Ilan Awerbuch with the Unitrust Companies in San Diego, and this has been Mortgage Watch.